The S&P 500 posts the worst week since September as Trump tariffs rattle investors. The U.S. stock market has just experienced its most turbulent week in months, with the S&P 500 recording its worst weekly performance since September 2024. As Wall Street closed on Friday, March 7th, 2025, investors were left assessing the damage from a week dominated by uncertainty surrounding President Donald Trump's aggressive trade policies and their potential economic impact. So now we're going to talk about the numbers behind the decline. The major indices all suffered significant losses for the week. The S&P 500 fell 3.1%, big drop for a week, marking its worst weekly performance since September 6, 2024. The Dow dropped 2.4%, its worst weekly loss since February. The tech-heavy NASDAQ tumbled 3.5%, falling to its lowest end-of-week level since early October. The Russell 2000, which tracks smaller companies, plunged 3.9% to its lowest level since June. Despite a modest rally on Friday, today, following the February job report, the damage had already been done. Since reaching an all-time high on February 19th, the S&P 500 has now fallen approximately 6%, wiping out more than $3 trillion in market value. Now let's talk about the Trump tariff roller coaster. At the heart of the market turmoil lies President Trump's rapidly shifting trade policies. The week was characterized by a series of announcements, reversals, and new threats regarding tariffs on America's largest trading partners. On Tuesday, Trump's administration implemented 25% tariffs on Canadian and Mexican goods, along with a 10% duty on Chinese goods. By Thursday, most of the Canadian and Mexican tariffs were delayed until April. On Friday, Trump teased new tariffs on some Canadian goods, creating further uncertainty. I'm not even looking at the market, Trump said on Thursday, before adding there will be a little short-term interruption. Tech, now let's talk about tech and financial stock. Tech and financials, they get hit the hardest. The market leaders that drove much of the post-election rally have been among the biggest casualties in the sell-off. Nvidia has lost $712 billion in market cap since February 19th. Tesla has shed $322 billion in the same period. Semiconductor stocks broadly cratered, with Nvidia dropping 10% this week alone. Financial institutions, including American Express, Bank of America, Citigroup, Goldman Sachs, JP Morgan Chase, Morgan Stanley, and Wells Fargo all suffered 8% or greater stock sell-offs. Let's look at the warning signs. Beyond immediate market reaction, concerning economic data has emerged. Consumer spending, now this is a big one. Consumer spending unexpectedly fell 0.2% in January, the first month-on-month decline in nearly 2 years. Now that's a big deal. This economy has been driven by consumer spending, us spending money, and we're not doing it anymore. That's a problem. Inflation, tariffs, all that stuff, okay? Sorry, I'm off the script, but whatever. Consumer confidence dropped 7 percentage points in February, the worst deterioration in more than 3 years. First quarter GDP is projected to decline at an annual rate of 2.8%, which would be the sharpest drop since Q2 of 2020. Treasury Secretary Scott Bessent has warned of a detox period for the U.S. economy, while the federal government's Doge-induced layoffs have added to market concerns. Okay, what happens next? Let's look at the historical perspective. History offers two conflicting perspectives on what might follow this market correction. Number one, the optimistic view. Research from Goldman Sachs indicates that 5% pullbacks have historically been good entry points, with the S&P 500 providing a median 6% return over the subsequent 3 months in 84% of such episodes. So that means 84% of the time, 5% pullbacks have good, you make 6%, whatever. Okay, the cautionary tale. During Trump's first term, Tariffs pushed the average tax on U.S. imports to 3%, and the S&P 500 suffered a 19.8% drawdown in 2018. Current and threatened tariffs would raise the average import tax to 13.8%, suggesting the potential for an even larger market correction. However, it's worth noting that market recovered quickly from the 2018 tariff-induced sell-off, recouping all losses within 5 months. The currency factor. What's interesting is the US dollar index declined more than 3% this week, the biggest weekly drop since November 2022. This contradicts expectations that tariffs, inflationary pressure would keep interest rates high and boost the currency. Instead, growth concerns and questions about the US exceptionalism have weakened the dollar against rival currencies. We don't want a weak dollar. Now let's look ahead. As investors like me and you navigate this period of heightened volatility, several factors will be crucial to watch. Number one, further developments in trade policy, particularly regarding the European Union. Number two, retaliatory measures from affected trade partners. Now, Canada and Mexico's getting pissed because we're, getting crazy on them, right? Number three, impact on corporate earnings, especially for companies with significant international exposure. Number four, consumer sentiment and spending patterns. Number five, Federal Reserve's response to potential inflationary pressures from tariffs. So, while the immediate outlook remains uncertain, history suggests that patient investors, like me and you hopefully, who can weather short-term volatility may find opportunities amid market turbulence. As JP Morgan Chase economists Bruce Kasman and Joseph Lupton noted on Fridays, Trump's policies appear to be tilting towards a less business-friendly stance than initially anticipated after his election victory. The ultimate lesson from market history remains clear. There has never been a period of uncertainty from which markets haven't eventually recovered. The question for investors now is not if, but when and how that recovery takes shape. Okay, so what does that mean for me and you? Top three things, right? Have some money, have some savings, right? Ideally 3 to 6 months worth of savings. Don't panic sell, right? And this is not financial advice, okay? This is what I'm gonna do. Don't panic sell. Don't start selling all your stuff. Dollar cost average, right? As the markets go down, you want to keep buying so that when they go up, all that money works for you, right? And probably number three would be make sure you diversify. Own several different type of industries, own some bonds, some cash, that type of thing. And I'll give you a bonus tip. Okay, number four, if it makes you feel good, hold some cash, right? Cash in your portfolios. As we all know, Warren Buffett has quite a bit of cash there right now. He sold quite a bit of stocks, and interestingly enough, he has sold all of his S&P 500 stocks, which is not much in his portfolio, right? But it is a significant warning sign as far as I'm concerned. Anyways, thanks a lot so much for watching, guys, and leave a comment below on what you think the market is going to do in the future, what you're doing to prepare. Like, comment, subscribe, do all those things. And if you like this kind of thing, definitely share this. Make sure you watch one of these videos here because that's what YouTube wants you to do, and I'll see you on the next one. Peace.